When the bailouts ended, the headlines faded. Markets stabilized, banks survived, governments declared the crisis contained. But beneath the surface, a deeper question remained unanswered. Did the financial system actually change, or did it simply reset? This is the story of what came after 2008. The reforms, the illusions, the unintended consequences, and the quiet rebuilding of a system that promised it had learned its lesson. By 2009, the worst of the panic had passed. Stock markets began to recover. Banks returned to profitability. Executives spoke of resilience and renewal. But the global economy was scarred. Millions were unemployed. Entire industries were reshaped. Trust in financial institutions was shattered. For the first time in generations, ordinary people questioned whether the system was built for them at all. Governments promised reform. This will never happen again, they said. New laws were drafted. New rules were announced. New watchdogs were empowered. The most famous of these reforms was the Dodd-Frank Act in the United States. It aimed to limit excessive risk, increase transparency, and prevent taxpayer-funded bailouts. On paper, it was sweeping. In reality, it was complicated. Banks were required to hold more capital. Stress tests were introduced to simulate economic disasters. Certain types of speculative trading were restricted. But finance has a unique ability. It adapts. Risk doesn't disappear, it moves. As traditional banks faced tighter rules, new players emerged. Shadow banks, private equity firms, hedge funds, non-bank lenders. Many operated outside the strictest regulations. The system was safer in some ways and more opaque in others. To prevent another collapse, central banks took unprecedented action. Interest rates were slashed to near zero. Trillions of dollars were injected into markets through quantitative easing. Money became cheap, extremely cheap. This policy stabilized economies, but it also changed behavior. Investors chased higher returns. Asset prices soared. Debt became normal, even desirable. A new era began. The era of financial dependence on central banks. Markets no longer asked, "Is this sustainable?" They asked, "Will the central bank step in?" And most of the time, it did. The recovery was uneven. Those who owned assets, stocks, real estate, businesses grew wealthier. Those who relied on wages alone often struggled. Inequality widened. Trust eroded further. To many, it felt like the crisis punished the innocent and protected the powerful. This perception reshaped politics, culture, and public debate across the world. Years passed without a major collapse, and slowly, confidence returned. Maybe the reforms worked. Maybe the system was stronger. Or maybe the risks were simply hidden better. Financial products became more complex. Technology accelerated trading. Algorithms replaced human judgment. Speed increased. Opacity increased. And with it, fragility. When new shocks arrived, market crashes, liquidity scares, global disruptions, governments responded the same way. More stimulus, more liquidity, more intervention. Each time, the system survived, but each rescue reinforced a dangerous idea: that failure would always be stopped, that losses would always be softened, that risk no longer had consequences. This is the unresolved legacy of 2008. When institutions believe they cannot fail, risk becomes rational. The system rewards size, it rewards complexity, it rewards influence, and it quietly pushes danger into the future. So did the system change? Yes, in structure, yes, in regulation, yes, in language. But at its core, it remains dependent on confidence, leverage, and human behavior. And human behavior hasn't changed. History teaches us something uncomfortable. Crises don't come from ignorance, they come from overconfidence, from believing that this time is different. The next crisis won't look like 2008. It never does. It will come from a new corner, a new asset, a new technology, a new assumption. But when it arrives, the same question will return. Who will be saved and who will pay? Welcome to Cash Chronicles, where money, power, and history collide.